All right, let's jump right in. On the surface, weather and the stock market seem like they live on completely different planets. I mean, one's all about atmospheric science, right? The other is driven by things like investor confidence and, well, money. But what if they're actually way more connected than we ever imagined?
Because, well, that's the thing. It turns out that when the weather gets crazy, the markets tend to follow suit. A huge storm brewing on the horizon isn't just a problem for meteorologists. It's often a sign that a financial storm is about to hit too.
So what if you could actually see it coming? I mean, what if there was a tool that could forecast the market's reaction to a weather event, giving you a chance to act before the panic selling starts? Well, that's exactly what we're going to break down today.
Okay, so to really get the solution, we first have to understand the problem. Why on earth does a simple weather report hold so much power over the stock market?
For the longest time, everyone saw these as two separate worlds. You had the physical world of weather over here, and the kind of abstract world of markets driven by human emotions over there. They seemed like totally separate forces, but we now know that's just not true. They are deeply, and I mean measurably, intertwined.
And here's the absolute crux of it. For the big institutional investors, the folks who really move the markets, a typhoon warning isn't just about bad weather. Nope. It's a gigantic red flag for chaos. They're picturing ports shutting down, supply chain snapping, production grinding to a halt. In other words, what they see is pure, unfiltered uncertainty.
And what's the first thing you do when you're staring down that much uncertainty? You protect yourself, right? The gut instinct for these huge funds is always the same. Sell first and figure out the details later. It's not even about what's already happened. It's all about dodging the chaos of what could happen. It's a pure survival move.
So if uncertainty is the villain of our story, then predictive data has to be the hero. And this hero has a name, Shangji. It's this incredible new AI tool designed to bring some serious clarity to all of this chaos.
So Shangji is the result of this really cool collaboration between Fudan University and the China Meteorological Administration. And its core job is actually brilliantly simple. It just digs through mountains of historical data. We're talking decades worth to find all the hidden connections between a specific weather event and how a specific stock reacted.
Honestly, this is the perfect way to think about it. We've all got weather apps, right? Okay, now imagine if that app didn't just tell you it's going to rain, but it also gave you a heads up that, say, a certain company's stock was about to take a nosedive because of that rain. That's basically the power Shangji is giving to these big institutions.
All right, so how does this thing actually work under the hood? I mean, how does an AI take data about the atmosphere and turn it into something you can actually use in finance? It's a pretty fascinating process. Let's get into it.
It really boils down to these four main steps. First, the AI just devours decades and decades of old weather data. Every storm, every heat wave, you name it. Then, it does the same thing with an equally huge pile of stock market data. Now, the real magic happens in step 3. The AI basically becomes a detective, finding all these subtle patterns that a human would never spot. It connects the dots and says, aha, when this storm happened, that company's stock did this. The end result? A powerful model that can predict how markets will react to the weather of the future.
Okay, this is where it gets really, really powerful. Because, having a crystal ball is one thing, but knowing what to do with the prediction is the whole ballgame. So let's look at a real-world example of how a company can use this foresight to get ahead.
So picture this. You're the CEO of a huge fruit company. Shangji's data shows you that, historically, whenever a nasty cold snap hits your main growing region, your stock price drops by about 5%. Why? Because investors totally freak out thinking your entire harvest is going to be ruined. That 5%, that's a predictable risk.
So in the old days, the strategy was basically reactive. You'd cross your fingers, hope for the best, and then try to clean up the mess with panicked investors after the fact. But now, with data like this, the approach is totally proactive. You use that early warning to protect the actual fruit and to manage what your investors are thinking. It is a complete game changer.
So how do they actually put this data into action? Well, the new playbook has two absolutely critical parts. It's not just about saving the crops on the ground. It's just as much about protecting the company's value in the market through some smart communication.
So on the operations side, this means taking real steps before the freezing weather even arrives. The company can fire up its frost prevention systems, they can line up a backup supply of fruit from partners in warmer areas, and they can even get a head start on their insurance claims. They're actively making the real-world damage smaller.
And this is the other absolutely crucial piece of the puzzle.
The CEO gets on the phone with the stock exchange and major investors. They basically say, look, we know the cold front is coming, but here's our step-by-step plan to deal with it. We've done A, B, and C, and we don't think it's going to be a big deal for our bottom line. And by doing that, they eliminate the one thing investors hate more than anything else, uncertainty. And that stops the panic selling in its tracks.
Now, you might be sitting there thinking, okay, but why all the fuss? It's just a little dip in the stock price. It'll bounce back, right? Well, not so fast. Turns out, even a small temporary drop can have some seriously devastating consequences.
Yeah, a falling stock price isn't just some abstract number. It sets off a really dangerous domino effect. It weakens the company's financials, which makes it harder and more expensive to get loans. It hurts company morale when everyone's stock options are suddenly worth less. And it can even put a big target on the company's back, making it look like a cheap meal for a hostile takeover. The stakes are, no joke, incredibly high.
And this impact isn't just stuck inside one company either. Think about it. An extreme weather event, like a massive flood in a big manufacturing hub, can cause one company's stock to tank. That spooks analysts, which can trigger a sell-off across the entire industry. And pretty soon, you've got the whole banking system getting nervous. The ripple effects can become massive and fast.
Which really brings us to this final fascinating question. Shangji is taking something as famously unpredictable as the weather and turning it into a manageable financial risk. So it really makes you wonder, as AI gets smarter and better at spotting these hidden patterns, what other giant, seemingly random forces in our world are next? What other uncertainties are about to become just manageable risks?